to the Digital Marketing Quarterly Trends Report from Skai for Q2 of 2024. We can start with some housekeeping information. You are in listen-only mode. If you try to talk back to me, try as you might, I will not hear you. However, you can submit questions via the Q&A button in your Zoom interface. That's the QA button and not the, yeah, just the chat, not the Q&A. You know what I mean. You've used Zoom before. If you're having sound issues, you can switch between your computer and your telephone. You've got all your dial-in information for that. That should be somewhere in your email box. And in that chat, you can see there is a link to download the slides we will be talking about today. But you will also be getting a recording of this webinar and those slides via email by end of day tomorrow, most likely. So keep an eye out for that as well. My name is Chris Costello. I'm the Senior Director of Marketing Research here at Skai. I am based in Chicago, where the weather is absolutely gorgeous today. I should be doing this from outside, but alas, I am not. So that's me. Who is Skai? Skai is the only omni-channel platform designed specifically for performance advertising. And what we do is we connect walled garden media and complex data, and that makes marketers it empowers marketers to unlock insights, to streamline their execution, and measure the impact on what we consider to be the highest engagement and highest return consumer touchpoints. You see some of the logos there for who we can connect you to. I mentioned omni-channel marketing. Now, omni-channel marketing is really a more advertiser-based concept. It's about breaking down silos and thinking about your program more holistically. And the way that we translate that into a broader analysis is looking at these channels through somewhat similar lenses. Not in all cases. Obviously, all of these channels are unique in their own way, but there are commonalities that should help you as a marketer understand them in context through a more unified lens. And we've got research. We've got lots of research at Skai. You can see here the link to our research center, where you can see 4 broad categories of content. There are advertising trends. That's what we're talking about right now. We run some consumer surveys about things like Amazon ads, Prime Day, for example, walled gardens, marketer insights. We talk to actual practitioners about retail media and their opinions on walled gardens. And we do custom research. Obviously, that's customized. I can't tell you what it looks like. If you go to our blog right now, we have a pretty comprehensive view of what happened on Prime Day. I could probably spend this whole hour talking about Prime Day if I wanted, but that fell outside of Q2. So we're not going to talk about it directly here on this call, but go and check that out for your own edification at a later time. The data that we are talking about today is drawn from Skai data hosted on the platform. So that comes to roughly 1 trillion impressions or over 1 trillion impressions, 14 billion clicks, $8.6 billion in spending. This is spread over 5 quarters across multiple countries and industry categories. We are primarily focused on domestic US programs. We are primarily focused on direct response or performance marketing. In a lot of cases, that means commerce, but not always. And to be included in this analysis, accounts within our system must have 15 consecutive months at the channel level, unless otherwise noted. Some outliers get removed as necessary. And we have to emphasize that this is based on spending from Skai clients only. It's not the whole. It is not all of Google. It is not all of Walmart. It is not all of Facebook. So as such, we like to think that we're in the ballpark, but we are not a perfect representation of those channels or those publishers. So please keep that in mind as we go through the data. What are we going to talk about? Here's our agenda for the next 54 minutes and 62 slides. We're going to go over some key findings. We're going to talk about individual channel analysis for retail media, paid search, and paid social. And then we're going to wrap up. We'll have time for Q&A. We'll have some additional resources that I'll share with you at the end. And in the past, we've had a separate section for what we're calling omni-channel commerce, but that kind of felt a little forced. So what we're doing this time is look for the shopping cart symbol on slides that have to do with commerce media, whether that's in retail media, whether that's in paid search or paid social. And that kind of provides a nice little through line for the types of analysis that talk about commerce in particular. So let's get going, shall we? We start with our key findings. What are we seeing at the top level? Overall, spending is still going up across all channels. Retail media, once again, growing the most. Their higher ad prices offset maybe slightly softer click growth. But one of the things that we're seeing, and we've seen, there's been lots of stories about this in the media, search, social, retail media, all are currently in a cycle where prices are going up, but also that impressions and clicks are starting to either grow slowly or even shrink in some cases. And that cycle looks like it kind of began in mid 2023. We'll get a bit deeper on this in a couple different places because it's really kind of important in the sense of if your prices are going or getting higher in these channels, what does that mean? What is the context for that? And what can you do? But again, we'll talk about that a lot over the next 45, 50 minutes. I mentioned that spending is continuing its positive trend. Here we can see both quarter over quarter in the dark blue and year over year in the light blue. Investment levels continue to grow in what we consider these primary walled garden ecosystems, and that underscores their value to marketers. You see on a quarter over quarter, retail media up 9, paid search up 5, and paid social up 1%. On year over year, again, retail media leading the way with 21% growth year over year, followed by paid social at plus 13, paid search at plus 6. And I mentioned that pricing is the primary driver. And what we mean by that for the year over year numbers in particular is here we look at the balance between volume and pricing for each of these three channels. So for retail media, that's clicks and CPC. For paid social, that's impressions and CPM, cost per thousand impressions. And in each of these cases, pricing went up more than clicks or more than volume, rather. You see that the second bar in each set is taller than the first bar. Search clicks, in fact, were actually down year over year. And that just means that you always have two factors, and we'll go in more detail on each individual channel. Anytime price goes up or down, it's because prices went up or down and volume went up or down. So that's kind of the first level of peeling back the onion to figure out just what's going on. And with those price changes, particularly those year over year price changes, I did a lot of deep historical analysis this time around because I want to figure out just what's going on, because I got stuff in my inbox about how search marketers are looking at other channels because CPCs are going up, so they're looking to social. I also got emails that said social advertisers are thinking their prices are getting too expensive, so they're looking at other channels. So it's really going in a bunch of different directions. But we have a lot of data at Skai. I've been at this, if you've been on these calls for a while, I've been doing this for quite some time. And so I went back to Q1 of 2020 and looked at year over year pricing by quarter for each of these three channels. And the first thing that should jump out at you is that these three lines follow fairly similar trajectories. And they also go from periods of increasing prices to periods of decreasing prices. We are in a period of increasing prices. If you look at retail media and search in particular, we've had year over year price increases since Q3 of 2023. Social is a little different, but social had a big flood of ad inventory in late 2022 in through 2023 that essentially devalued their individual impressions or their cost per thousand impressions. That's why you see that curve down lower than everything else. Now, the other thing you should see is the tail end of all of these, from Q1 to Q2 is starting to come down. So this gives us hope that perhaps in the second half of 2024, we will start to see some relief from these year over year increases in prices. That's going to be maybe a little different from sequential quarter over quarter, but in terms of where we are now compared to where we are last year, again, we may start to see that come down a bit when we get into the second half. And then I mentioned commerce media. Here we have our shopping cart. And once again, to denote that we are talking about commerce, I want to look at quarterly growth. If we look at commerce media across Google and Meta in particular, we see that Google quarter over quarter overall grew 6%, Meta grew overall 2%, but shopping campaigns on Google, and that includes PMax, Performance Max was up 11%, almost double that. Um, Bidding methods that target revenue were 1 point higher than the overall total, and it's not a perfect match with shopping, but it is another indicator. For Meta, product ads, dynamic product ads, the core uh, ad type for commerce was way up over the average at plus 15% quarter over quarter. And then what are called outcome sales, sales objectives, and we'll talk more about the objective structure of Meta a bit later, was also up around 16%. So commerce really moving the needle there in terms of that quarterly growth, on top of the retail media channel, which we've seen is also, healthy and robust relative to the other channels. And another view of shopping that was interesting this quarter is with all the talk of Performance Max, and Performance Max is an important piece of the overall search ecosystem. Regular old standard shopping is still chugging along here. Right now on this chart, you can see the percent of Skai accounts that are using standard shopping campaigns and the percent of spend using standard shopping campaigns. And adoption in terms of accounts has actually increased somewhat over the last 5 quarters. Spending has kind of remained pretty constant in that 12 to 13% range, except during the seasonality of Q4 where it bumps up. So with all the talk of like new shiny objects within search, some of the old faithful stuff is still proving to be a big part of campaigns for some advertisers. So that gets us kind of the first chunk of high level results. But now we want to go a little bit deeper into each of our individual channels, and we will start with retail media. Now, I should mention when we talk about retail media, we are talking about on site, on app advertising. Within Amazon world, that's called Amazon sponsored ads. So sponsored product ads, sponsored brand, sponsored display. It does not include Amazon DSP. Same goes for example, Walmart is Walmart Connect, does not include Walmart Offsite DSP. Right now, we're putting those in their own category of display. But there was a good article in Digiday like a week or two ago that, somebody posited that retail media is any ads you buy from a retailer. So that would then include DSP. And there's an argument to be made to keep that in. Actually, if you read the Amazon Prime Day stuff, you'll see how DSP and sponsored ads are perhaps working a little more closely together as more advertisers use both arms of that publisher. But anyway, I digress. Where are we in Q2? Spending growth was still the highest of our 3 channels. Came in a little bit slower than last quarter. Last quarter was plus 24, I think, year over year. But nearly 2/3 of accounts went up at least 5% year over year. So still healthy growth for retail media going on. One reason for that slowdown, again, there's that year over year click volume, particularly from Amazon, that began in Q3 of last year. And that means that the rising prices had to carry more of that growth. I'll show you another view of that long range chart in just a second. So we start with that plus 21% year over year spend. Now let's unpack that into its component parts. And here again, as we kind of talked about earlier, you see clicks were up 9% overall. I think for Amazon, it might have been closer to 6, and the CPC up 11%. So it's about, even, but CPC has a little bit of the edge there, but that hasn't been the case historically. If we looked back at Q2 of last year, for example, clicks grew 36% year over year while CPC was flat. So the math between change in clicks and change in CPC changes over time. That's, why the spending curve may not always be smooth. It's a little, it's not going to, even if you're holding your budgets constant or you're constraining your budgets, there's going to be some variance in there. And that's why we do these calls. So you can kind of see where that nets out. But again, we've got lots of data. We went back in kind of the full history. I think actually Q3 of 2020 was the first time we may have reported on retail media entirely. I have to check that. I think that's true. And you can see these clear cycles. We looked at the CPC before in the context of the other channels, but here I put that click growth on top of it. And you can see that whenever CPC is on the front foot. When CPC growth is high or even positive, that click growth is maybe not negative, but lower than it had been previously. So you can see these clear cycles where CPC is up, click growth is down, vice versa. And then if we look a little deeper, we'll look at this a little bit, and we've talked about it in the past. Early signs indicate that these high CPC cycles also have higher conversion rates, which could be one of the reasons that this is happening. This, and this isn't just us. We've seen this in other reports in the marketplace that talk about these same trends. Um, and the question that this brings up is, are there are prices going up because there are fewer clicks, or are advertisers buying fewer clicks because prices are going up? And we don't really know, but it sort of doesn't matter. I think as advertisers, for the retail media folks on here, there are always different tools at your disposal that you can use. If prices are getting high, you can lean into day parting, you can lean into budget caps, you can lean into audience targeting optimization. All of those things would have the effect of perhaps increasing CPCs and decreasing clicks, but not necessarily at the cost of your program efficiency, which we'll see on the next slide. Because for year over year percent change within retail media, and this is just for Amazon, where we've got a bit of a cleaner read on conversion metrics, you can see that conversion rate was 12%, the same as CPC. So you're getting, a better rate of return for perhaps smaller growth in clicks. And as a result of that, your conversions, we see 18% growth year over year compared to that 19% year over year for Amazon, the Amazon component of that overall retail media number. So you're getting, when you see conversion rate go up, that means that fewer clicks are needed to maintain overall conversion volume. And that can subsequently mean that each of those clicks can be bid up a bit to make sure that you get that, that ROAS goal or that conversion volume goal. So rising prices aren't necessarily a bad thing in all cases. And I made this point in a video that we put on LinkedIn. You have to keep an eye on the prize. You got to keep an eye on your conversion metrics and your ROAS when you see rising CPCs, and look at it quarter over quarter, look at it year over year to give you that context. One of the other things we like doing when we're looking at the channel is not just saying, hey, spending went up 21%, because, everyone's a little different. So let's look at it in terms of a distribution. If we look across all Skai accounts, how many of them went up quarter over quarter? How many of them went down as a percent of total? We do that for spend. We do that for CPC. And here you can see particularly that second bar down on the chart, obviously to the right, up at least 5% year over year, and to the left, down at least 5% year over year. You can see that 63%, nearly 2/3 of Skai retail media accounts, increased spending by at least 5%. In all cases, it was either an outright majority or a plurality of accounts that were up versus down. This again kind of speaks to the overall growth of the channel. And, it's easy, I would hope, for you as a marketer to figure out where, which side of the fence you're on, and figure out how many other folks are in that same boat. We also like breaking out our spending growth metrics by month. And here you can see a little bit on the right, we've got the percent differences for April, May, and June year over year. It is softening a little bit, but we did have a pretty robust, strong Amazon Prime Day. Once again, record setting, because it keeps going up, and that's just math. But we do think that there's some volatility in these numbers that I don't necessarily think is a actual deceleration. So it's something to watch, not necessarily something to stress out over. You may have noticed a slightly different format to these slides, but we're still giving you all the same information we gave you before. For example, we want to condense all of our core metrics quarter over quarter or by quarter onto one slide. So here you have them in a table format. Impressions, clicks, and spend are indexed. So that Q2 2023 is 1.0, and everything is relative to that. Actual values for CPC and CTR, and then you have your percent change as a chart there on the right. So you can kind of get that lay of the land. We've discussed a bunch of these already, like the 9% click growth, 21% spend, 11% CPC, for example, but here you have it in one nice little slide. We already talked about conversion rate, but what about ROAS? And here you can see the red line is ROAS. You've got spend, you've got conversion value or advertiser sales revenue or whatever you want to call it, and conversions. ROAS dropped slightly quarter over quarter, year over year, that red line, but stayed fairly level despite all of this movement going on in terms of spend and in terms of pricing. Perhaps more importantly, you see that the three bars are pretty much moving together with the exception of Q4, where everything gets slightly out of whack. And that tells you that this slowdown in click volume hasn't really hurt performance all that much. Spending is still up, and these other metrics are keeping up with spending. Next, we are going to look at key segments. And for this, we have my favorite, the bubble chart. And how to read this bubble chart is you've got year over year CPC on the right, on the x-axis. So as you move from left to right on this chart, the year over year difference in CPC is getting bigger. Not the absolute CPC, we'll talk about that next, but the relative year over year CPC. And the y-axis is year over year spend. So as you go up on this chart, your year over year spend is bigger. The size of the bubbles is proportional to their share of spend over 5 quarters. And you can see that Amazon, the Americas, sponsored product ads, first party vendors are all larger bubbles. And as such, they're kind of closer to that overall. They don't move quite as much. There's a diagonal line on this chart that represents where all of the movement in spend is described by just CPC. So if you had the same number of clicks and CPC went down 10%, your spend would go down 10%. You'd be on that line. So anything above that diagonal line had higher clicks as well. Anything below that line had fewer clicks. It's the best way I could think to not have to show you 4 different slides on how all this stuff moves. And then what you can see from this is, in particular, I've circled Walmart, I've circled third-party sellers, and when you kind of combine the percent difference and the relative size of those segments, those 2 segments had the most influence over year spending and CPC trends. So you got a bunch of stuff bunched up there. Other retailers, yeah, is moving the needle in the other direction, but not quite as much as Walmart is moving them in the positive direction, for example. I mentioned that that was relative CPC on the x-axis. This is another bubble chart, but this time we've got last year's CPC in Q2 on the x-axis and this year's CPC on the y-axis. So anything that moves up over the diagonal line went up in CPC year over year, but you can also get a sense as to where things shake out. You can see, for example, Amazon CPC is generally higher than Walmart's. America is higher than the rest of the world. Sponsored brand and sponsored brand video are a bit more premium than just your regular sponsored product ads, and so on and so forth. So you get a sense as to where everything lays out. Talked about Walmart. I want to focus on them a little bit. We can look at their spending by ad type. We break it out by sponsored products and sponsored brands here. You can see that sponsored brand ads are growing faster than sponsored product ads. The red-ish bar is taller than the light blue bar, and also showed a much bigger seasonal bump in Q4, which is interesting. I don't know what necessarily to make of that yet. At this point, it's just, that's interesting. As for adoption of sponsored brands with that volatility, I wanted to look at that here, and you can see that they're still building in terms of adoption. Up from maybe 60% of total to 65% of total accounts on the platform that are running Walmart are running sponsored brands. Makes up about 10% of total spend. By comparison, all accounts that we have are running sponsored product ads. So there's a bit of a gap here at the top of the page, if you will, for advertisers to maybe kind of beef up their presence going forward. Once again, this is just our experience with Walmart. This doesn't necessarily mean this is how everything looks on Walmart if you had 100% of their spending. Breaking that out by CPC, we can see that sponsored brands actually command a higher price. They're more premium than sponsored products. We did see that over at the overall level across all publishers on the bubble chart, but here you can see just how much that's shaken out. Sponsored products, on the other hand, have grown a bit more year over year. You see in the table on the right, Year over year spending up 22% versus 8 for sponsored brands. What about ROAS? Well, there's a higher CPC for sponsored brands. That means lower ROAS overall, but then also still has that same seasonal spike that we saw in overall spend. Next, we want to talk a little bit about Amazon, particularly DSP. This has a little bit of a different flavor. This is only looking at DSP, and this is with no filters. In the past, we've done things like, hey, let's look at Amazon accounts that are using sponsored ads and look at their use of DSP. This is a little bit different. It's always tricky to figure out how to best fold that in, but this gives you a good sense of the growth where spending has doubled year over year on Amazon DSP. The number of accounts running DSP has grown by 50%, and the number of campaigns running DSP has grown by just over 50%. Taking our same view of ad type CPC, but on the Amazon side, you can see again that all ad types increased in CPC, both quarter over quarter and year over year. Sponsored brands grew the most compared to last year. And it goes to strategy that as an advertiser, you need to balance those higher CPCs against ROAS goals, other KPIs, but really more from a mix perspective. You don't necessarily want to look at the, I'm going to do it on the next slide. I'm doing it on this mostly because it's kind of the common language that we've seen across the industry. But while we can look at ROAS by ad type, and you can see that it's slowly declined across all three year over, from Q4 on, you see those curves going down. Sponsored display did show a bit of jump over year, but I would caution you about looking at ROAS of individual ad types. That kind of defeats the purpose of this omni-channel view. Is you want to look at your overall program and how the mix of these things affects your overall ROAS, for example. And now that I say that out loud, maybe we'll do that for next time. Break the cycle of looking at individual ad type ROASs because it's not necessarily helpful. Breaking things out by industry now, another bubble chart. This is again CPC on the x-axis, spend on the y-axis. Here the bubbles do not reflect relative size. Just because that gets into like weird artifacts of what our book of business looks like. When you look at it this way, beauty and personal care, you see up almost 40% year over year. So that's definitely a big mover on the spend side. Also pretty healthy in terms of the CPC side. So that had a big impact, a big gravitational pull on the overall, if you will. Computers and consumer electronics on the other end of that spectrum pulled overall spending growth lower. And one of the ways that size of these segments does come into play is food and groceries is a fairly decent sized segment. And while it is still positive year over year in terms of CPC, it did pull the overall year over year CPC somewhat lower. Again, that gravitational pull of these individual industry category segments on the whole. If we look at where those CPCs live, you see that consumer electronics and computers saw the largest drop year over year. Again, they're kind of the farthest off of that diagonal and going down, both in percentage and absolute terms. And then you kind of see some natural sorting of what's going on. You've got family and community and health that are the top tier. You've got beauty and personal care kind of just getting up on the border to get into that more high-priced segment. And then you've got a cluster of other folks that are either near the average or below. And one of the other things we've been doing over the last couple of reports is trying to synthesize our history of Skai reporting into an easy to read chart where we kind of, for every individual quarter, we've got 5 different reads on it because we, again, recycle our sample every quarter to do this analysis. And when we plot that, now that we know what to look for, we talked about these cycles of clicks versus pricing. You can kind of see these different cycles where clicks grow faster than spend and vice versa. This is when prices go down, prices go up. But now that we know what to look for, it's kind of interesting to see how these cycles, they're not straight chronological cycles. It's not like they go up for a year and go down for a year. So there are other things at work. I mean, we had COVID in 2022. That definitely affected what was going on. We had stronger or weaker perceptions of the economy that are a factor in there too. And sometimes you do have inventory or systematic changes to these platforms that can do that. So this is something, this is hopefully a good way for you to contextualize your program and figure out, oh, my prices are up. Is it just me or is it everybody? Well, on average, it's everybody. So that concludes our retail media portion. We're going to be moving on to paid search as soon as I take a sip of water because, repeat after me, hydration is important. So paid search at a glance, spending grew 6% over last year, the same rate of growth as last quarter. If you saw Google's earnings call the other day, they also showed their search numbers being the same as it was in Q1. So that's a nice, confirmation that we're on the right track, even if our absolute numbers are somewhat different. Performance Max, we talked about them already. Those campaigns more than doubled year over year, as those campaigns have at this point almost completely replaced Smart Shopping, which was its immediate predecessor. And then just over half of Skai search accounts increased spending by at least 5% over Q2 of last year. That's that distribution view that we'll take a look at a little more closely later. But first, we want to unpack that overall search spending growth number. So we're at +6 year over year, but you can see clicks were actually down 2%. So were impressions. CPC was up 9%. So that's really driving the bus entirely on the search side. Branded keywords was one of those areas that we actually saw CPC growth up a bit more heavily. That does raise some questions about things like conquesting and bidding on a competitor's brand terms and where things might be moving the needle there, but that's a little bit deeper than we can get into in this analysis. In terms of distribution, about half of search accounts increased both spend and CPC, and that's both quarterly and year over year. You can get a sense again where you sit in terms of your program just by looking at this. Hopefully that helps you understand your program in the context of the overall channel. And I mentioned keyword, or no, I didn't. Sorry, I'm getting ahead of myself. I want to go back to an analysis we did 2 quarters ago when we were looking at that overall drop in clicks. And these are waterfall charts. The way that you read this is from left to right. So, for example, in Q4 of 2023, our year over year clicks were down about 8%. And the components of that, if we look at it, we broke it down to these migrations of different ad types. So on the keyword text ad side, we had expanded text ads, and those were kind of yielding the way to responsive search ads, or RSA. And you see legacy text ads dropped about 5% in total clicks. RSA kind of made up 3% of that difference. Then you see legacy products. So this is standard shopping and smart shopping. We see a big drop in clicks there. Performance Max made up about 2/3 of that gap. And then some other stuff brought things down again. So from this, you can say that, okay, both of these migrations were essentially costing total click volume. And PMax was probably a little bit bigger than RSA in that regard. If we repeat that now in Q2, you can see in the middle of the chart that the PMax has more than made up the click deficit from legacy product ads, but we still have this persistent gap between legacy text from expanded text ads and responsive search ads. So that kind of changes the game a little bit, where it used to be both of those migrations. The PMax migration is a little more one for one at this point, but text is a little different. So what's going on with those keyword ad click trends? If we combine legacy and responsive search, you can see that clicks dropped 5%, more than that overall 2%, but CPCs were way up. Again, we talked a little bit about branded search ads being part of that. Spend grew more than the overall channel then at +8%, but we also see, as similar to what we looked at for retail media, conversion rates were up year over year. Total conversions were up year over year. Now, measuring conversions for search can be a little more imprecise because advertisers have the flexibility to designate whatever they want as a conversion event, but it mostly comes out in the wash. And we go back to the similar thing to what I said for retail media, and that is that higher conversion rate means that fewer clicks are necessary to achieve similar or better conversion volumes. And that implies improving efficiency for keyword text ads as those responsive search ads replace expanded text ads. They're working harder, irrespective of the supply and demand side of it, where prices going up might cause you as a marketer to buy fewer clicks, or the availability of fewer clicks might make you pay more per. They do seem to be working harder. So the net result is still, maintaining levels of performance for marketers. Again, your mileage may vary. We'd love to talk to you more about it. You can always reach out, and we can delve into your individual situation. Breaking things out by month, we do see a little bit of deceleration from April to May to June. I think that's well within just regular variation and noise. It's only a swing of 3 points over the 3 months. But we do like to see it just to get a sense. Last year, you can see that spending was level to slightly up from May to June. This time it was slightly down, but maybe a little more in line with the same average daily spending, because June has one fewer day. So that's your monthly view. Again, wanted to give you the overall numbers here. This is, again, your impressions, clicks, and spend are indexed. You can see our, and the way to understand that, if this still isn't quite clear, is you look at Q2 2024 and you see that our indexed impressions are 0.98. Our indexed clicks are 0.98. That translates to down 2%, because you're going from 100 to 98. And everything else you can see, spend up 6% year over year, 5% quarter over quarter. You can see that CPC growth was up both compared to last quarter and to last year. We've talked a lot about Performance Max, and now let's focus on it again. And ding, ding, another commerce slide. Adoption of Performance Max has reached half of all Skai search accounts in Q2, up from under 40% a year ago. And that's on the left. And you also see the share of spend up around 13%. On the right, you see the actual growth of clicks and spend in CPC. You can see that spending has more than doubled. Click volume is up more than 2.5x. You can see that CPC is largely held for the last 3 quarters. But I also, earlier on, we talked about, well, that's Performance Max. What about standard shopping? What about other shopping modalities within the search stack? And here you can see the difference between Performance Max, the dark blue, standard shopping, the light blue, and then I included smart shopping on here. You can see how it's been gradually deprecated. Now less than 10% of accounts are utilizing it. On the right, you see the share of spend, and Performance Max obviously gaining as a share of total, but in Q2 of 24, it's about evenly mixed between standard shopping and Performance Max. One of the reasons that standard shopping has been kind of the bulwark, if you will, of the shopping function within search is transparency, visibility into what's going on. You hear that advertisers can get frustrated because they can't necessarily see into the black box for Performance Max. We have been making efforts to peer into that black box for you by looking at the assets that are coming out of Performance Max. As you may or may not know, Performance Max dynamically assigns assets to a certain ad based on when, where, who, and all that good stuff that it knows about you. But, we talk about Performance Max primarily as a shopping campaign. And here you can see that borne out. If you look at the share of spend in the first half, you can see 2/3 of that spend coming from shopping as an asset, followed by text being the second largest, images there as well. In fact, if you break it down a different way, 90% of our accounts that are using Performance Max are using it for some amount of shopping, non-zero amount of shopping assets. There are folks who don't use any shopping, but obviously that's the other 10%. There, it's much more heavily text by like a 3-to-1 margin over images. And then you also see the CPC on the right. And this kind of contributes to that persistent trend within search that uh, shopping ads tend to be priced lower than other search ad types. And that's, that may be a function of how the inventory lays out on the page and all that other stuff. But, consistent with what we've seen before the PMAX era, if you will. Breaking down our segments, you can see I've included Performance Max in the shopping bubble here, and that's one of the reasons why that is the biggest mover, the highest up on the y-axis. And you also see on the bottom end, you see Microsoft maybe down a little bit year over year and spend down a little bit year over year CPC. You see mobile moving more than desktop. By and large, you see everything clustered up and to the right. That speaks to kind of the broad growth. We definitely saw this in retail media as well. I didn't mention the color coding. I kind of tried to make it so it was easier to separate out the different dimensions we're looking at. We're looking at publisher with the dark blue, so Google versus Microsoft. Device, you see mobile versus desktop. Technically I could put tablet on here, but it doesn't really add much to what we're talking about. Bidding target is about the bid method that you select, and that can be driven towards a revenue goal, whether that's ROAS or total revenue, a conversions goal, whether that's a CPA or a conversion volume goal. Cost is predictably on the low side in terms of CPC and spend, because that is the thing that you're controlling for. And then our campaign type for keywords versus shopping on here. Now, your experiences may vary in terms of how much you move in any direction. A lot of that comes down to what your relative share is in these different segments. So here we again see how it's laid out relative to each other. We see that keywords are more expensive than shopping. If your program is more heavily keywords than shopping, if you have no shopping, for example, your CPCs are going to be higher than average. Same goes for if you are targeting conversions, not necessarily transactions, but conversions as your goal within the thing. Or if you're more heavily on desktop, if you're more heavily on desktop, you tend to have higher CPCs. So this is a good way to maybe understand how you differ from the overall averages. And then we want to look at things by industry. Here, again, the size of the bubbles don't matter, but travel did have a very strong quarter, both in terms of year-over-year CPC and spend. They've been on an upward trajectory ever since the big COVID hole kind of blew a hole in that category within the search space. And then you see, things like B2B goods and services, jobs, and EDU actually grew year over year in terms of spend, despite having lower CPCs. And obviously that means more click volume. That's why it's above the diagonal line. I would also point out the dark blue consumer goods and retail. If you've been on the last couple of calls, that had been a little bit weaker over time. Some of that seemed to be due to the transition to Performance Max, but now we seem to have critical mass of that in terms of the year-over-year comparison. We're seeing consumer goods and retail bounce back somewhat in the year-over-year number. I do think if you were to put together a drinking game for me doing these webinars, somewhat is probably one of those things that would get you messed up if you drank every time I said somewhat. Looking at the CPC by industry, we can see jobs and EDU still way out in front of everyone else. As I've said in the past, this is a segment that is much more focused on lifetime value. So, individual quick prices are a drop in the bucket compared to the thousands and thousands of dollars from, getting someone to go to your university, for example. But you do see that's a class all by itself. You see that kind of mid-range group of industries in terms of health and finance, tech and telecom, B2B goods and services, kind of in that 150 to 250 range, maybe as high as $3 in some cases. And then kind of your lower priced segments, consumer goods and retail, CPG, obviously have a heavier footprint in shopping, which we've seen are lower priced, but travel also in there. And then our long-term trends. And, I'm definitely trying to figure out what we can glean from this view other than just, saying, hey, we've been doing this for a long time. But I would call out that typically you do see CPCs go down the red line from Q4 to Q1 and then bounce back from Q1 to Q2. So on some level, increasing CPCs from Q1 to Q2 is a seasonal phenomenon. So in that context, it is maybe not as surprising. So that takes us through paid search. We're going to motor through paid social. We've got 15 minutes ish less left and a bunch more slides. Some of them are transition, so we'll do it. I have faith in my ability to talk really fast. Our Q2 numbers at a glance. Meta has largely moved to kind of a second phase. They had a big campaign restructure over the last couple of years. And now that all of that is in place, we're starting to see advertisers start to optimize more aggressively against it. And one thing that happens with that is you're starting to see CPMs go up while impressions slow down. This is kind of the inventory uh, impact of or cause for some of these fluctuations that we've seen over time. Um, and then the segment of other social publishers continues to grow faster than Meta. You can see here that we're plus 13% overall for social, plus 9 for Meta. That means that everything that's not Meta is growing faster. Some of this is market. Some of this may actually be a Skai trend, which I usually try to separate out. Sometimes it's unavoidable. And I think here we have expanded our support for across non-Meta social publishers. So there might be a little hint of a Skai trend in that number as well. And we see, about 3 out of 5 accounts growing more than 5% year over year. So once again, let us unpack that overall number, that plus 13. It was plus 9 for Meta, so we're going to break that out here as well. For the overall channel, the dark blue is pretty a little more balanced between impressions, clicks, and CPM in terms of what was driving that growth. For Meta, a little different. Impressions actually flipped negative. Clicks were still up. CPM was up a little bit higher, and then that spending came in at plus 9%. And Meta CPM has been growing sequentially for most of the last 12 months. And that means that, especially when you look at it this way, it is the tailwind for year over year spending growth, where impressions maybe not so much. Our distributions, most social accounts increased spending year over year. They were a little more split when it comes to changes in CPM, particularly year over year, about even in terms of up versus down there. Looking at our core trends, we've covered most of this already, but here it is, a nice slide for your reference. Talked a little bit about non-Meta, and a big part of that is TikTok. So just over 1/3 of Skai accounts in our analysis, and that's again 15 months of continuous spending across the entire social channel. Just over a third are now running TikTok. That number has doubled year over year. That's what you can see here on this chart. This is the number of accounts. I probably should have put that somewhere on the chart, right? But yeah, this is the number of accounts from quarter to quarter. Spending levels are still a little more volatile. It is still a relatively small sample, but those have also increased in that time. And again, some of this is TikTok continuing to grow. Some of this is Skai expanding our support for TikTok. We do expect that TikTok's shopping capabilities are increasing over last year, and historically, that inflection point tends to come between Q2 and Q3. So we'll be watching that next quarter to see if that jumps. I want to talk a bit about campaign objectives on Meta. And not everyone, I've been told anecdotally that not everyone at Meta knows that they're called outcome-driven ad experiences, or ODAX, but I just like saying ODAX, so I'm going to keep calling it that. And that is a set of streamlined campaign objectives. There used to be 11 campaign objectives, and now there are 6. Advertisers can no longer create new campaigns. I think they actually stopped delivering ads on them in Q2, and you can see that on the next slide. The share of spend from ODAX is now 94% of total spending for Meta. Legacy objectives are mostly gone at this point. And then if you look at Meta, we saw some of these numbers already. Impressions are down 2%, but spending is up 9% and CPMs are up 12%. And so this is that second phase. Not only are advertisers adapting to these new objectives, is they're kind of setting up different competitive sets. For example, you might have had product catalog sales and conversions as your campaign objectives. Now all of those may be under outcome sales. And so you're kind of competing, or you're streamlining. You might have had duplication there that you don't have now. And things of that nature. And that's one of the reasons why it introduces a lot of volatility into impression volume and CPM, and makes some of the spending numbers a little bit harder to predict. We've talked about shopping across channels. I want to talk a little bit about advantage shopping campaigns on Meta. This has gotten a lot of headlines over the last, several quarters. And here we saw spending kind of stay level from Q1 to Q2, but it has grown nearly 6x year over year. That's the dark blue bar. Impressions have kind of come back a little bit. Impressions went way up during Q4. That might have just been, weird dynamics of a new thing within the structure. It might have been a couple big advertisers doing some stuff. If we look at it as a share of total, the share of advertisers is more than doubled year over year. Share of total Meta spend has increased over 5x, kind of on par with that 6x growth overall. This is another one of those things. This is somewhat reminiscent of where PMax was maybe a year ago. And we do expect to see an inflection from Q2 to Q3. We expect to see this go up, particularly on the share of accounts in the next quarter. One of the other dimensions on the Meta side of the ledger is placements. We talk about Reels, we talk about stories, we talk about whether it's on Facebook or Instagram. And you can do that in two different directions. You can start with platform. So let's look at Facebook, and then let's look at Instagram, and then look at all the individual components: feed, stories, Reels. And so that's on the left. You can see that obviously your total Meta, we said, was what, 9%. The Facebook component less than that, Instagram higher than that, but Reels doing pretty much all the work on the Facebook side in terms of making overall spend on Facebook rise somewhat. And then Instagram, still Reels doing a lot of the lifting, but feed and stories also contributing in a positive direction. If we do it the other way around, if we say what was the overall for feed, what was the overall for stories, what was the overall for Reels, you see feed ads maybe down a little bit, primarily on Facebook. That's what's pulling that down, even as Instagram feeds or Instagram feed ads increase. Same thing for stories. You've got Instagram kind of counterbalancing that decline on the Facebook side, and then you actually see bigger growth on Facebook Reels than on Instagram Reels, which is interesting. It's kind of an art, possibly an artifact of how those areas are presented on each of those, whether it's desktop, mobile, and where those ads get placed. Now, how much of each of these things is going on? If we look as an overall total, Facebook is still dominant in terms of ad inventory. 2/3 of spend in this is over 5 quarters. 2/3 of that spend going to Facebook, and you see the ratio of feed to stories to Reels. Overall, still primarily feed. Facebook definitely, overwhelmingly feed. Almost 80% of spend on Facebook Blue is coming from feed ads, but then a bit more diversity there on Instagram. You see a healthy segment from stories, and then Reels making up a bigger chunk as well. So that takes us to the end of what we have prepared for you this hour. Just to wrap things up, we see a common element across these digital channels where ad volumes are either slowing or decreasing, while ad prices are going up both sequentially or year over year. But in many cases, we looked at this for retail media, we looked at this for keyword ads on search, performance has not really been affected. KPIs such as conversion volume, ROAS have largely kept pace. And this implies that we may be seeing an increased efficiency that's subsequently due to these mix shifts in ad inventory, where these newer formats, whether it's PMax, RSA, ODAX, have gone through an initial more disruptive transition phase and are now being optimized. And that doesn't mean that's the only reason we see these pricing versus volume trade-offs. There could be, elevated levels of consumer intent could be driving this, as we've talked about in the past. There could be other supply and demand things going on as well, but the efficiency one is the take-home message that, clearly as we see some of these prices going up, we're also seeing performance keep up with it. So that may be the silver lining in some of these price increases, is that obviously your mileage may vary, but in general, it seems that performance is keeping up. That brings us to the Q&A part. I'm going to go over and look at the chat and see what we got going. There's a question, are there any notable PMAX conversion rate and or CPA trends as PMAX adoption increases? I will have to get back to you on that. I don't have that ready in front of me. Um, we saw with the CPC in particular that there was a bit of volatility in like Q2 and Q3 of last year. And that's, I think, as you're kind of wringing out the system, that you're moving from your your high performing terms tend to go first, and then the long tail after that. And that's, we've seen that with adoption curves across the board, but I may have to get back to you on conversion rate or CPA trends for Performance Max. Once again, I'd like to remind you that if you go into the chat, you can download these slides and review them at your own leisure. This is me stalling to see if we get any more questions in. But I think we're good there. I'm sorry I didn't give you a Spotify playlist this quarter. I was not as motivated. I was not as inspired this time to come up with something. Last time we had the Eclipse, right? Didn't I have the Eclipse playlist? Anyway, I digress. Okay, we don't have any more questions, so I'm going to move on to what our additional resources are. We talked about this at the beginning. We do have the Skai Research Center, where you can get everything you need to know about ad trends, consumer surveys, marketer insights. Again, there's that. I like to think of it as very comprehensive Prime Day blog post that you can check out as well. I would like to thank you for taking this hour. I actually finished early. 70 slides in less than an hour. Good God, that's crazy. My name is Chris Costello. I've been your guide through this trend analysis of Q2 2024 across digital marketing. We are Skai. We'd like to thank you for taking the time. I hope to be with you again in 3 months, where we will talk about this more. And if you threw some questions in late, we'll try to get to them later. But that concludes the webinar for this time around. And again, hope to see you in 3 months, where we'll talk about Q3. So long.